So which options do I like? I like the options that expire on Friday, either this Friday or next Friday. I like in the money by $1 or $2. The more, the better, but keep in mind, the further in the money you are, the more buying power you're going to use, and the more, how can I say it? It's going to lessen your risk if you're more in the buying power, but the closer you are to at the money, allows you to buy more share size. Does that make sense? You guys understand that? Okay, because if you're $1, then those options, if you're $1 in the money, then those options will probably cost you like $2.50. Whereas if you're $2 in the money, they're going to cost you probably $3.40. All right, so I like options that expire Friday. Why Friday? Because Friday has more open interest. I like playing the indices. I like trading the indices because the indices are less volatile to earnings and news events. Most of the news events that affect the indices happen to be on scheduled events like GDP, FOMC statements, FOMC reportings, federal rate hikes, things like that. They're pretty much scheduled, so there's usually very little surprises in the market. Now, there can be some surprises like Apple, which would affect the FNGU, and of course, when the FNGU gets affected, it does affect the SPY and the QQQ greatly. All right, because the FNGU is, in my opinion, the main driver of SPY and QQQ. Now, I have two spreads on, so you guys understand that. I like not spreads. I like options that are $1 to $2 in the money. Okay, and they expire on Friday, and they're no more than 14 days out. Okay, I like them less than 14 days out. All right, I like a lot of open interest. So the ones that have more open interest tend to be like 480, 485. 485 will typically have more open interest than 481, 482, and 483, and 484. So it's a lot of spreads based on the $5 increment. So they tend to have more open interest in those numerals, in those divisible by 5 or multiples of 5. So 480, 485, 490, 495. You guys get the picture there. Now I have two spreads on. Well, actually I have multiple spreads. I've got a spread that expires today. All right. I placed it yesterday. All right. Now what I did was I sold 487 calls and I purchased 489 calls. Now I can't sell calls short and be naked. Okay. So I have to buy to offset it so it limits my liability. So there's a $2 difference between the calls that I sold and the calls that I purchased. Each call is 100 shares. All right. So if it's a $2 difference and there's 100 shares, I'm liable for $200 of liability between the ones that I purchased and the ones that I sold. And if I did two of them, that means I'm liable for $400 of liability between the ones that I purchased and the ones that I sold. Now, I sell the shorter strike, the lower strike, because it's a bear call credit spread. So the premium I received, you can see I didn't receive premium, all of this in premium, but the premium that I will have received is 47 cents minus the 16 cents. So you can see here, I take 0.47 and subtract 16 cents. We'll call it 17 just for be more truthful. All right, so that leaves me 30 cents. So what did I receive for credit? I received 30 cents times, I got 2 contracts. Each contract is 100 shares. So I times that by $200 because each contract's 100. So I times it by $200. So I times 200. So I received $60. Now, if the SPY starts to roll over and head down today, I can roll that 487 call down to a 486, down to a 485. If it starts to break below 484, I can bring it down to 484. And those are my options. Now, as I roll it down, you can see what would happen if I roll it down. So let's just, we'll hit trade, all right? And you can see right now it's trading at 11 cents. If I closed it out, that would have been at the close of yesterday. Now, if I roll it down, all I've got left in there is 11 cents. So if I roll it down, let's say I roll it down to the 486s, all right? So I can capture another 12 cents on that. You see that? Because it was trading at 487 between 11 and 12. Let's say I close it at 12. And I roll it down $1, and I choose to sell the 24s, I get another $12. So that $60 turns into $80. All right, because I got 200 shares, and I'm putting another 12 cents added on to that because 24 minus 12. All right, so 0.24 subtract 0.12. All right, that's 12 cents times 200 shares because I got 2 contracts, adds another $24 if I'm able to roll it down and sell it for 24 cents a share. All right, so that takes my 60 and add that onto my 60. That gives me $84. Now let's just see what happens if I roll it down one more dollar. All right. Now keep in mind, I'm not touching my long strike. All I'm doing is manipulating my short strike. Now, if I roll it down to $85, it jumps up to 46. All right. So we were at 24. All right. So you take 46, subtract 24. I get to add 22 cents onto it. So that's 22 times 200. That gives me the ability to add 44 onto my 84. So that's just by rolling it. $44 plus my $84. All right? So now I'm at a place where I'm making $128 for selling these 2 spreads if I'm able to roll it down to 485. Let's say the market heads down to 481. I want to roll it down to the 84s. Well, the 84s are selling for 82 cents. You guys get the gist? Each time I roll it down, I'm getting more money. All right? I'm adding more money. But here's the point. I got to defend 84 now. If this closes, if I don't take my profit, all right, before it gets back over 84, then I owe them money. All right, that could cost me money if it comes back up over 84 and my strike is 84. All right, so I need this to close below 484 if I choose to roll it down to the 484. Right now, I need price to close below 487 by 4 p.m. today. Now, if I see an opportunity and it's a 10-minute downtrend and the market's rolling over, I will have the opportunity to roll it down to 486s, 485s, maybe 484s. We'll see how low it goes. I don't think I'd go any lower than 484 though. So that's how a spread works. Okay? You sell 2 calls. You can't have naked calls. So you buy 2 calls. The difference between the 2 calls will be what you're liable for. If you have 2 of each and there's a $2 difference, you will be liable for $400 of risk in between. Everybody get that? You guys see what I'm saying? On the spread, it's a bear call credit spread. Not getting any response. Mike got it. All right. Thanks, Mike. All right. The same thing is not easy. All right. Well, okay. Then, all right. I want to help Marley. You're a little bit confused. What part didn't you understand? The calculations? The calculations, okay? All right. See, I have, okay, I'll start from the beginning. I chose calls. It's a bear call credit spread. I sold 2 calls. You got that right. All right. So I sold 2 calls. Now I can't have calls naked sold. So I have to buy 2 calls. So I buy 2 at a cheaper price. So I bought the 489s, but I bought those for 16 cents a share. For each share, I bought that option for 16 cents a share, or 17 cents, because it's 16.5. All right, so I get a credit of whatever the difference is. All right, so each share I take 47 and subtract 16. All right, so 0.47 subtract 0.17, and I'm changing it to 17, okay, because it's 16.5. I'm just going to round it up and make it less favorable for me. Okay, so I do that. I don't know why I did that. 0.47 minus 0.17 gives me 30 cents. You understand that, right? Okay, 30 cents. All right, because each contract is 100 shares. All right, and I have 2 of each. Okay, so if a contract's 100 shares, it's going to cost, I'm going to capture 30 cents per share. And I've got 2 contracts, so 2 times 100 is 200. So now I'm going to take the 200 and multiply that by what I captured for a credit because I sold these short. All right, so I sold them. So I capture a credit of 0.3 times 200. So I got a credit of $60 for selling this, well, actually for placing this spread. Now, in order to keep all of my $60, I have to make sure that price does not close over 487. You understand that? Because if it closes over 40.87, I'm going to owe them money. Yep. Okay. All right. But if it closes over 489, my 489s will give me credit for anything over 489. But the 487, so I'm liable for, there's a dollar difference between the two. There's a $2 difference between the two. 487 and 489 is a $2 difference. And there's 100 shares in each. Okay, so I've got 100 shares in each one, but I've got 2 contracts, so that's $200. All right, so that's 200 because I've got 200 contracts, 200 shares. One option is 100, the other option is 100, another 100. That gives me 200 shares, and it's a $2 difference. Times 2 is $400. That's my liability. That's what the risk is for this whole trade, is $400. And I only got $60. But for me, I think it's a good trade because I don't think the market's going up to 487, or I don't think it's going to close over 487 because we just hit 6-year resistance. So for me, I like that trade. All right. But if market starts to break over 485 and over 485.50, I will have to defend that trade. In other words, I will probably just close this down at break even or take a small loss. All right. Right now, I've got profit in this trade. You can see if I close this out now, I've got $69.96, basically $70. I will have made, of the $60 that they've given me credit, okay, if I close it out right now, all right, I'm going to get $70. I'm just going to round that up, minus the $29.03. I'll just call it $29. Minus $29. So that gives me 41. All right, so I will capture 41 of the 60 that they gave me. All right, so in other words, they gave me $60 for placing this trade right up front. They gave it to me. Okay, if I close it out right now, I have to give them back $19. All right, but I got to keep 41 of it. That's if I close it out right now. Now, if it goes all the way back, I might have to give all $60, but it didn't cost me anything. All right? That's the point, is it didn't cost me. You always make more when you sell options than you do when you buy them, because you got the time decay on your side. So as time decays or price moves in the direction that you expect it, your option winds up your spread winds up working for you. So I will have to give them back $19. But I will have made 41 of the 60, and I'm fine with that. If I make $41, I'm good with that. It's $41 that I didn't have. It was buying power or capital that I wasn't using. So I just put on the spread and I captured $41 just for killing time right through there. All right. Now we're going to go into the rolling part. Is that the part that confuses you? Rolling it. When I roll it, I close this out for Okay. When I roll it, all I'm doing is I'm leaving the long strike alone. All right. I'm not even touching it. All right. I've decided that I'm willing to give up 17 cents a share because I think I got the top nailed right here. So what I'm doing is I'm just going to play around with the short strike. Now, if price starts to go down, I get the opportunity to close it out for wherever it's at. Now, where is it at? I look at where it's at now. It's at 12 cents a share. If I close it out now, all right, I will have made this much, 47 minus the 12. All right, because I sold it short. So what I'm doing is I said I sold it short at 47 and I'm willing to cover my short at 12 cents a share. So this is how much I've captured so far of my profit. Okay, so I take this, my calculator, and 0.47 minus 12 means I've captured 35 cents of that. But bear in mind, it's going to cost me 16 cents if I want to close the whole trade. But I'm not ready to close the whole trade yet. Instead, I'm going to capture my 35 cents per share right now, and I'm going to roll them into another contract that gives me a little bit more. So I roll it down from 487 down to 486. Okay, now there's 24 cents. All right, but now keep in mind, price is a little closer to 486 than it was to 487. That's why they're willing to pay me more. All right, the lower I go, okay, the more they're willing to pay me to sell it short. You see what I'm saying? But I don't want to sell 484s because price is currently at 484. I stand a good risk of having to come up with 200 shares to satisfy that option. Because if I sell somebody the option to buy calls at 84 and the price is at 85, I owe them that money. I owe them 200 shares at 484. So that would be $1 difference if price was at 485 at the close and I was holding 484 calls that I sold short. I would owe them, if I have two contracts, I would owe them $200. And in essence, it would cost me to do that spread. So I want to keep it at a place or a distance that I can defend from. So I don't want to do 484s. I only want to roll it down, let's say $1. So you noticed I closed out the 12 cents per share and I load in 24. Now these will decay, assuming price is headed south. But I can't do that until price heads south. As long as price is bullish and flat and moving up, I'm in jeopardy of having price go up to 487. All right? But if I roll it down and price is going down, then I can follow it down, roll it down to the 486s, and now I get to capture an extra 12 cents. I say extra 12 cents because remember I closed these out at 12 cents earlier and rolled it down from 487 to 486, and now I'm selling the 24 cent 486s short. You see what I'm saying? In other words, I'm going to capture more by selling it short as long as price moves down. You guys understand that, or did I confuse you again? You got it? Okay, because remember, I was selling the 12 cents. All that was left was 12 cents in selling those short. All right? And I'm saying to myself, well, Market's going down, I can roll these down to the 486s and capture an extra 12 cents per share. Now, if you're able to, if market goes down to like 480, you can see I can move them down to the 484s and capture another 70 cents. Why 70? Because I sold those for 12. I covered my shorts for 12 cents. All right, so I got to knock 12 off of that. And then I get to load in 82s. So there's a 70-cent difference. So in essence, I'm able to take the $60 and add another $70 to it, giving me $130 just for using capital that I'm not using. And the reverse goes for the bull put spread. The only thing I have to do is when price crosses 485.5, I have to shut this down because now this is in jeopardy of being exposed to price action. But I don't think it's going to get up to 487 because we're at 6-year resistance right now. So that's why it makes sense. So in essence, I put on a 2-day put. So you can see I did the same thing again. All right, a bear call credit spread that expires tomorrow, right there. You see what I did? I sold the 487s, bought the 489s, and that one expires tomorrow. And then I did it again for the next day out. All right, so I got 2 that expire on Tuesday, that's today. 1 spread that expires on Wednesday, that's tomorrow. And 1 spread that expires on Thursday. All right, that's Thursday. That's 2 days from today. And then I've got 2 spreads that expire 6 days from now. That's next Friday. No, that's not next Friday. That's going to be January 29th, which is right here. That's going to be Monday. Yeah. Hey, good morning, Carly. So that's where I do. That's where I make a little bit extra money by doing bull put credit spreads and bear call credit spreads.